work for the credit union, and we absolutely do. We work for Alliant Credit Union. We happen to be in the Alliant Retirement and Investment Services Department of Alliant. Both Malcolm and I are based in Denver with offices in the Tech Center and in Lakewood. But if you're joining from another state, which I think most people are today, we are happy to do virtual appointments. Thanks for joining us. Malcolm's going to walk you through. This is a brand new webinar for us called Irmma, and it's about the surcharges that occur with your Medicare Part B and Part D premiums based on your income. So good information. He's going to walk you through all those details. We will take all your questions at the end of the webinar today, so feel free to enter those into the QA or the chat box, and we will follow up with you. You'll get a phone call or email from one of us just following up on today's session. We've got a couple other webinars coming up. The first one is going to be Thursday this week. This is on Social Security, all the details and the rules of when to apply and how the different claiming ages affect the amount of your benefits.
I think it might be
if
us
you're
today.
interested in that, watch for the email to sign
Iris
up.
is out
And
then.
also
Is
on
New York thing, right?
Thursday, June 4th, we're doing an annuities webinar. We call it the good, bad, and the ugly about annuities. It's completely educational. Annuities have really come a long way over the last decade. We're not talking about any particular one. We're just explaining the different types and all the pieces that go into that. We also have quite a bit of resources on our available to you. First, webinars. There's our colleagues across the country are doing webinars as well. So if you go to our webpage and then click on the events page, you will see other webinars that are being conducted. You're free to sign up and
for
attend
me,
any
just
of
working
those
on
you
GTFS
want.
things was mostly
We also
closing up
produce
a
an
lot of
in-house
PRs and getting the
podcast, and we
API
house all those
stories
historical
ready for the
podcasts on our
sprints.
podcast page. So
Mostly
if
the
you're looking
sprints and
for
starting today because
information
I'm
on a
going to be starting
specific
on the
financial
API
topic, you
stories.
might go
So
there and
that's
find
going to
something
be
that's
my
just
main
what you're looking
focus.
for. And
Also
last,
might be
our
out for
website
an
and
hour
our
or two
blog
today.
both
Not
have
feeling
just a
too good,
ton
so
of
I might get some
information
rest.
about
Make it up
various
later in the
financial
evening.
topics. So again, if you're trying to
But
get
yeah, that's
smart
all
on
for me.
something or introduced to something, you might go there and find just what you're looking for. But thanks again for joining us, and I'm going to turn you over to Malcolm and look forward to talking with you soon.
For me, I was doing PRs for my
well, thanks, Kim. As Kim mentioned,
this story
this is
with
kind of a new
the
webinar for us. And the reason we're bringing this to you is we want to make sure that you understand what Irma is, an income-related monthly adjustment amount, and it has to do with Medicare. We're going to, again, the reason we're doing this is we want to make sure that you're educating you regarding this because we're starting to see more and more people subject to Irma, and they're like, well, what is this? What is this? Why am I being charged more for my Medicare Part B premium and D? So again, we want to bring this education to you and make sure that you're aware of it. So here's the agenda. This is what we're going to be covering today. What is Irma? What determines Irma? There's something called a modified adjusted gross income. What counts towards that determines what Irma is. What's excluded from modified adjusted gross income? What are the income brackets that they look at for Part B and D premiums? How to appeal if you think your income is higher than it should be, causing you to have higher Part B and D premiums. How to appeal that. Strategies to reduce your modified adjusted gross income, and some key takeaways and action steps. So this is today's agenda. So let's start off. Well, first, what is Irma? Irma stands for Income Related Monthly Adjusted Amount. So in essence, it's a surcharge to your Part B and D premiums based on the income you receive. Now, the income is determinarily calculated looking at your modified adjusted gross income. The thing is, like when it comes to Irma, they look at what your income was 2 years ago. So, for example, if you're on Medicare right now, or maybe you're going to retire in 27 and that's when you're going to turn on Medicare, in 2027, they're going to look at what was your income in 2025 to determine what your Part B premium is. Now, the interesting thing about this is Irma is something somewhat new. It didn't take effect until 2007. It was part of the Medicare Modernization Act. So we're starting to see more people kind of affected by this because prior to 2007, it didn't exist. So here's a little bit of history of Irma. In 2000, between 2007 and 2010, the bracket started at 80,000. If your modified adjusted gross income was over 80,000 as a single person or 160 as a joint person, your Part B premium increased. Now, the good thing between 2007 and 2010 was those brackets did increase a little bit each year. In 2011 is when they added Part D premium or Part D Irma, meaning Part D is your prescription drugs for Medicare, and that's when they started charging you more based on whatever your income was. In 2011 through 2018, they held the brackets the same, meaning those 7 years, the brackets did not change at all. Now, during that time, we saw about a 1.6% inflation, but when it came to those Irma brackets, they did not change at all. Kind of sucks. In 2019, they added the sixth layer for high income individuals. If your income was over 500,000 for an individual or 750 as a joint, there was this additional layer. And then 2019 and beyond, again, they are back to increasing those brackets, which is a good thing. So, what is modified adjusted gross income? There's multiple modified adjusted gross income, and depending on what you're trying to qualify for or what you're subject to taxes or they look at different formulas. But your modified adjusted gross income is the specific formula that Social Security Administration uses to determine what your Irma surcharge is. Of course, it's not a standard line item on your tax return, but here's the formula. They look at your adjusted gross income, which is line 11 of Form 1040, and then any tax exempt interest, which is line 2A. This is your modified adjusted gross income for Irma. This is what they look at to determine Irma for Medicare. There are other modified adjusted gross incomes that are out there. They look at different things for different things, different items. For example, ACA, which is the private health insurance before 65, they look at a modified adjusted gross income also, but they look at it differently. So, but when it comes to Medicare, modified adjusted gross income, these are the two items that they look at: your adjusted gross income and any tax exempt interest. Now, what counts towards the taxable income of this modified adjusted gross income? They look at your income. Did you have any income, salary, earnings if you're still working? When it comes to kind of retirement, did you take any money out of your IRAs or 401ks or RMDs? That money is considered taxable, which is part of your adjusted gross income. Social Security, they look at your taxable portion of Social Security. Investments, kind of passive income, capital gains, interest, dividends. They look at muni bond interest, even though that is tax-free interest. They look at that. If you have any rental income, they also are part of that adjusted gross income. They also look at Roth conversions. If you're coming in and taking money out of your traditional IRA and moving it over to a Roth IRA, that income is considered taxable, which is part of that adjusted gross income. Now, some things that they currently do not look at, that it's excluded from your modified adjusted gross income, is Roth withdrawals, as long as they're qualified distributions. Now, qualified distributions mean as long as you've had the account for 5 years, you're over 59 and a half, all earnings and interest come out tax-free, which is not part of your modified adjusted gross income. Health savings account. If you're still working and you have access to a health savings account, I highly encourage you contributing to it. Because if you think about it, you can put money in pre-tax, money gross tax deferred, and as long as you're taking the money out, it comes out tax-free. those distributions are not part of a modified adjusted gross income. Also, when it comes to life insurance, let's say you have cash value in those life insurance. Usually you can take that money out and it's not included in your modified adjusted gross income. Or let's say you had a life insurance policy on your spouse, your spouse passes away. You get a tax-free death benefit. That's not included in your modified adjusted gross income. Now, let's look at these brackets because there's a bracket for individual filing jointly. So let's use an example. Let's say you're an individual and your modified adjusted gross income is $160,000 for the year. So that means you look at this bracket, 160,000, you're in the, say, the third tier. That means your Part B premium is $405 a month. Now remember, it's always a 2-year look back. So in 26, they're looking at what your income was in 24. In 27, they're going to look at what your income was in 25. So it's it's important to understand the mechanics of how they look at Irmma. If you're a filing joint married couple and your income is $300,000, again, your Part B is 405. Now, it's the same bracket for Part D, which is prescription drugs. So, example, if you're a single person, your modified adjusted gross income is 160. You're paying $37.50 plus whatever your Part B prescription drug plan is. Again, if you're a married couple, your income is $300,000. It's $37.50 plus your plan premiums per person as a married couple. So let's use an example. Meet George and Martha. They're both retired. They're collecting or they're receiving Medicare Part B and D. And in 2024, their modified adjusted gross income was around $205,000. But they had some mutual funds that kicked out unwanted capital gains, which was around $15,000, which caused their modified adjusted gross income to be $220,000. Well, this happened in 24, so they kind of forget about it. And come 2026, all of a sudden they get their letter from Medicare and say, hey, by the way, your Part B and D premiums are increasing. $81 for Part B and $14.50 for Part D per person. So their Medicare surcharge was a total of additional $2,300 for that single year. And they're like, why? Well, again, if we look back at what your income was in 24, which is your modified adjusted gross income was 220, that puts you at your Part B of 284, which was an increase from 202. And then, so it's at $81 per person. And then your Part D increased additional $14.50 per person because of what your income was in 24. So again, looking at George and Martha, they forgot what their income was in 24, but Medicare caught up to them and said, surprise, your Part B and D are increasing because of your income. Now, what are some things that you could be doing to help reduce your modified adjusted gross income? There's something called a qualified charitable distribution. Now, this is only available for anybody over 70 and a half. Once you reach 70 and a half, you can give up to $111,000 a year out of your IRAs directly to charities. That $111,000 is not added to your taxable income. So this would help you reduce what you have in your IRAs and also help you reduce what your required minimum distributions are going to be down the road. So here's an example. Let's say in 2026, your RMD was $20,000. You have two choices. You can take that full $20,000, pay taxes on it, and it's added to your taxable income. Or you can come in and say, hey, I'm going to take $10,000 of that, add it to my taxable income, but this other $10,000, I'm going to give directly to charities, and that is not added to your taxable income in that year. So it's a way to reduce your taxable income. You could also start thinking strategically doing Roth conversions. Again, this is when you're taking money out of your IRAs and you're converting it over to a Roth IRA. You're staying within a certain tax bracket, which ultimately down the road helps you reduce what you have in IRAs. We'll call this the gap opportunity. Best time for conversions, let's say, is between the age of 62 to 73 or 75. Let's say you're retired at 65 and you're like, hey, I'm going to delay my Social Security till 70. Maybe those are good years to do Roth conversions. No, you're going to be in a lower tax year based on previous years of you working. So it's looking for years where you're in lower taxes. And all you're doing is coming in and saying, hey, I'm going to pay a 12% tax on it versus a 24% tax liability on it down the road if I'm going to be in a higher tax bracket. So Roth conversions can be a strategic way to reduce your tax liability. Now, I'm not saying everybody should do Roth conversions, but it's something to consider. Let's also talk about tax loss harvesting. What tax loss harvesting is, at the end of every year, you come in and say, and this has to do with money that you have in taxable accounts. And if you have multiple positions, you might come in and say, hey, is any of my positions that I have, I'm able to sell at a loss? Because now if you sold that position and you have a capital loss, you can offset those capital losses by capital gains. All capital losses offset capital gains. And also, you're able to deduct up to $3,000 of capital losses. So let's say you have $10,000 of capital losses for the year. Well, you get to use $3,000 this year, and you can carry forward going forward, or carry forward for the following year. But let's say, going back to the example of George and Martha, let's say you had $10,000 of capital losses, and these mutual funds generated $15,000 of capital gains. Well, the $10,000 of capital losses reduces those capital gains, so now you only have capital gains of $5,000. So again, this is another strategic way to lower your modified adjusted gross income. Also, managing withdrawal sequencing. If you're retired and you know that you're going to be in a much higher tax bracket, maybe withdrawing money from your IRAs to reduce that tax liability down the road. Or maybe you're already in RMD age and you're like, well, I already have to take this money out, but if I take any more out of my IRA, like it's going to push me into a higher tax bracket. Maybe taking money out of your Roth IRAs or taking money from the taxable accounts to give you the income you need without pushing you into a higher tax bracket. So it's managing how you're going to replace your income throughout retirement. Again, qualified distributions from Roth IRAs and HSAs are not counted towards your modified adjusted gross income. Also, think about timing large income events. If let's say you're self-employed, you have a business, you're going to be selling your business in a couple of years. Start trying to manage those big income years where you're going to have. Maybe think about, hey, if I'm going to sell a business, maybe spread it out over a couple of years so it doesn't push you into a higher tax bracket. Or if you come in and say, hey, I know I'm going to sell this real estate in a couple of years, and there's going to be a big capital gain subject to that, look to see if there's ways to produce capital losses to help you reduce those capital gains. So start thinking about what are things coming down the road that could cause me to have a big income event. If you are still working, maybe it makes sense to contribute pre-tax into 401ks and help you reduce your taxable income for the year. I'm not saying it may or may not make sense to do this, but it is another way to reduce your modified adjusted gross income, especially if you know that, hey, down the road, like based on what I've saved, majority of my money's in Roth IRAs. By putting money into the pre-tax, it does help me reduce some of my modified adjusted gross income. It's just looking at your situation and saying what makes the most sense. Now, there are certain things that you can do to appeal this Part B premium. Part B and D premium, and it has to do with life-changing events. Let's say that in one of the qualified events, let's say that you retire in 2027. They look at what your income was in 2025. Based on you having a high income in 25, you might be able to fill out form SSA-44 and request them to recalculate your Part B premium and say, hey, look, I retired. That income that I was receiving in 25 is no longer there because I retired. Or maybe you had a death of a spouse. Maybe you got divorced. Maybe you lost a pension or sold an income producing property. Maybe you had an employer settlement payment in that year, which only happens once a year. Well, you could also come in and say you had a sale of a business. That's a reduction in your income. So there are certain things that you could be doing to appeal this Medicare Part B premiums. Now, you might have to do it a couple different times, but it's worth kind of going through the exercise and saying, hey, I'm going to complete this form, I'm going to submit it, and hopefully they come back with a kind of a positive outcome saying, hey, your Part B premium is lower because of this. Now, something to be aware of when it comes to retirement. Let's say in 27, you fill out this exemption form and they say, yeah, your Part B premium is lower because you retired. Well, come 2028, you're going to have to do the exact same thing because they're going back and looking at what your income was in 2026. Well, if you were still working in 2026, your income is high, and so you're going to have to complete this form again. So just be aware of that, because even though you put a form in place for the exemption, they forget about that. Sorry. So again, it might be a situation where you just have to continue filling that form out to come in and get your Part B premium decreased. Now, some key takeaways or some action steps to kind of think about. Review what your modified adjusted gross income is. Review your taxes. And based on your current tax liability today, are you going to be subject to Irmma or not? Also, kind of think about the future in regards to what you've accumulated. How is that going to impact your future taxes 5 or 10 years from now? The thing that sucks about Irmma is that if you cross one of those levels by $1, your Part B premium increases. So be aware of that. Look at some of the Irmma calculators that are out there. Make sure you're consulting with your accountant and say, hey, let's start doing some tax planning. So start planning to reduce your modified adjusted gross income, especially if you think you're going to be subject to Irmma down the road. Here's an example of John and Mary that came and saw us. And this is some of the planning that Kim and I do. John and Mary came and saw us. They both retired at 65. They're now 67. John has some health issues, so we think he's going to live to about 80. Mary's going to live to 95. She has good longevity in her family. They both receive pretty good Social Security amounts. Mary also has a pension. They have money in IRAs. They have money in savings. And really don't really spend much. I mean, they did all the traveling they wanted to while they were still working. So their retirement, they live in they're not really spending much money. They're spending about $4,000 a month. They're paying $500 each for healthcare, and we're looking at federal and state taxes. So the first thing that we do is we put all these numbers together and basically look at a comprehensive plan for them and just say, hey, based on the income you have coming in, we know you're never going to run out of money because you're only living on your Social Security and pensions coming in. But the problem that you're going to have is at 73, your combined required minimum distribution is $115,000. That's the amount that you have to take out in that year, and each year it just gets bigger. Let's look at tax liability. Yeah, right now you're in a 12% tax bracket. but RMDs is going to push you into a higher tax bracket. And especially if one spouse passes away, you're going to be even pushed into a higher tax bracket. And this is assuming that taxes kind of stay the same. If taxes eventually go up for whatever reason, you could be even subject to even a higher tax bracket. So it's kind of this surprise, because if you look at 2031, your modified adjusted gross income is around 98,000. But when you are subject to required minimum distributions, they add another, whatever that amount to RMD is, and more of your Social Security is subject to tax. Your total income is 241,000. That's a huge jump. And when you see that jump, it could push you into a higher Irmma bracket at that point when you just compare those 2 years. So one thing that we could look at doing is say, hey, let's consider Roth conversions. If we do conversions over the next 6 years and we fill up a bracket of 22%, which does push you into paying a little bit more for your Part B, but is it worth it? And when we run this and show you this is the amount that you can convert and still stay within a 22% tax bracket, maybe it makes sense. I mean, at the end of the day, when you look at taxes, you're saving almost $400,000 in taxes. That's the amount of money that you get to keep that you're not giving to the IRS. But when you compare the two side by side, saying, hey, if you don't do any conversions versus conversions, with no conversions at 73, you're looking at 241,000 modified adjusted gross income. But on the right side, with doing those Roth conversions and helping you reduce your tax liability, now we're under 200,000 for modified adjusted gross income. So we're able to get below those Irmma brackets and not keep your Medicare Part B at a lower amount. So there are different ways to kind of think about this when it looks at your current tax liability and what you're trying to accomplish. Now, I know today's webinar was pretty short. This is the short kind of topic, and hopefully get a lot of questions regarding this. But Kim and I are here to help you kind of manage this, or guide you through this kind of maze or roadmap, can you think, when it comes to your financial life. So a lot of what I showed you is the software that we use to kind of look at your big picture, put all these pieces together, do a lot of tax planning, but also come in and be able to help you reduce some of the modified adjusted gross income that you're subject to, and hopefully keep your Medicare Part B and D to a premium. And it might be a situation where you just come in and say, hey, look, paying a little bit higher for Part B is not a bad thing, knowing that you're able to get more of your money over to our tax-free bucket. So we're here to help you. There's a lot of things that we can help you with in regards to creating a withdrawal strategy, looking at Roth conversions, you name it, we're here to kind of help you. So again, today's webinar is a lot shorter than I expected. And like I said, I hope we have a bunch of questions. I am going to put a poll out there. If you would like to set up a meeting with one of us and run a comprehensive plan, please indicate that. And we'll make sure to reach out to you and go from there. So, Kim, are you still around?
Yes, I am here.